If you made money in crypto, it probably wasn't because you were smart. It was because you were early or lucky. But the people who keep their money play a completely different game. And almost nobody is talking about that game. Most people enter crypto with the same idea. They think it is a market where intelligence is rewarded, where research leads to profit, where finding the right coin leads to wealth. That idea is comforting. It suggests that money is a result of being right. But in reality, crypto is not a market that rewards intelligence. It is a market that rewards timing, behavior, and discipline. And most people fail not because they are wrong, but because they behave the same way as everyone else. They enter when prices are already high. They exit when fear is already widespread. They confuse motion with progress and activity with control. Crypto creates a very powerful psychological illusion that more decisions lead to better outcomes. But in markets, the opposite is often true. The more you act, the more you expose yourself to randomness, emotion, and error. Most losses in crypto are not caused by bad assets. They are caused by bad behavior. People do not lose money because Bitcoin fails. They lose money because they buy when it feels safe and sell when it feels dangerous. The market is not designed to deceive you. Your own brain does that naturally. We are wired to follow crowds, to avoid pain, to seek quick rewards. Crypto simply amplifies those instincts. That is why so many people experience the same cycle. Excitement, optimism, confidence, greed, anxiety, panic, regret. And then silence. Most people who lose money in crypto do not talk about it. They simply disappear. And that creates the illusion that everyone else is winning, but they are not. The truth is simple and uncomfortable. Crypto did not create a new way to make money. It exposed how humans behave around money. And that behavior has not changed for hundreds of years. Tulip mania, the dot-com bubble, the housing market, different assets, same psychology. Crypto is not special, but the speed at which it moves is. And speed destroys reflection. When prices move fast, people stop thinking and start reacting. That is why most people do not actually participate in the crypto market. They participate in the emotional experience of the crypto market. They are not investors. They are emotional participants. And emotions are extremely expensive. The people who make money in crypto are not smarter. They are calmer. They do not chase. They do not react. They do not need to be right every day. They simply avoid being wrong in a big way. That is the first and most important difference. Not strategy, not coins, not charts, behavior. If you understand that, you already understand more than most people in this market. Most people imagine that money in crypto is made by finding the next big coin. They imagine someone discovering Bitcoin early, or buying Ethereum before it became popular, or finding a token that goes up 100 times. That story exists, but it is not the dominant story. It is the exception. Most sustainable profit in crypto does not come from prediction. It comes from structure. There are three groups of people who consistently make money in this space, not because they are lucky, but because their position in the system gives them an advantage. The first group is infrastructure. These are not traders. They are service providers. Exchanges earn money on every trade. Wallet providers earn money on usage. Payment systems earn money on flow. They do not need prices to go up. They earn money from activity itself. When the market is euphoric, people trade more. Infrastructure earns more. When the market crashes, people panic. Infrastructure earns more. They are not betting on direction. They are positioned on motion. That is why most long-term winners in crypto are not investors. They are builders. The second group is long-term holders. These people do not trade. They do not chase trends. They do not seek constant excitement. They accumulate slowly, patiently, and emotionally detached. They buy when nobody cares. They hold when nobody is excited. And they sell when everybody is emotional. Not because they are brave, but because their system protects them from themselves. They use fixed schedules, fixed rules, fixed positions. They remove decision-making from moments of emotion. That is the core advantage. The third group is volatility managers. These are traders, but not the kind people imagine. They do not predict markets. They manage risk. They think in probabilities, not certainties. They think in exposure, not conviction. They think in survival, not victory. They accept small losses easily, and they protect against large ones aggressively. Their goal is not to win big, it is to not lose badly. That mindset alone puts them ahead of most participants. Most people do the opposite. They seek big wins. They avoid small losses. They grow confident when things go well. They double down when things go badly. And they disappear. The people who remain do not fight the market. They design around it. They assume that they will be wrong sometimes. They assume that emotions will appear. They assume that uncertainty is permanent. And they build systems that survive those conditions. This is the part most people misunderstand. Crypto does not reward belief. It rewards positioning. It does not reward optimism. It rewards structure. The people who make money in crypto rarely feel like they are winning. They feel bored. They feel repetitive. They feel unemotional. That is why they remain. Profit in crypto is not an event. It is a byproduct of being correctly positioned in an unstable system. And that positioning is rarely exciting. It is quiet. It is patient. And it is deeply unromantic. That is why most people do not do it. They are not looking for returns. They are looking for stimulation. And stimulation is the opposite of stability. The people who last in crypto do not play the game. They design themselves out of it. Most people do not fail in crypto because the market is unfair. They fail because they approach an unstable system with a fragile mindset. They enter with expectations that do not match reality. They expect clarity in a system built on uncertainty. They expect safety in a system built on risk. They expect control in a system built on randomness. That mismatch creates frustration, and frustration creates bad decisions. The first reason most people lose money is timing. They do not enter markets when prices are low and interest is absent. They enter when prices are high and stories are everywhere. They enter when the emotional cost of not participating feels higher than the financial cost of participating. That is not investment. That is social pressure. The second reason is overconfidence. After one or two good trades, people begin to believe they understand the system. They confuse luck with skill. They attribute success to intelligence and failure to external factors. This is extremely dangerous because it encourages larger positions, greater risk, and less caution. The third reason is emotional attachment. People fall in love with assets. They identify with coins, communities, and narratives. They stop seeing positions as risk and start seeing them as identity. And once money becomes identity, rational decision-making becomes almost impossible. Loss becomes personal. Criticism becomes threatening. And exit becomes psychologically painful. So they stay longer than they should. The fourth reason is the illusion of control. People believe that watching charts gives them influence. They believe that constant monitoring prevents loss. But attention does not equal control. It often increases stress, reduces clarity, and amplifies reaction. The fifth reason is the absence of an exit plan. Most people know how they will enter. Very few know how they will leave. They do not define risk. They do not define loss. They do not define enough. So the market defines it for them, and the market is not interested in your emotional well-being. It is interested in liquidity. The final reason is that most people want certainty from a probabilistic system. They want guarantees. They want signals. They want someone to be right. But markets do not offer certainty. They offer distributions, and people who cannot tolerate uncertainty will try to eliminate it through action, which usually creates more risk. The tragic part is that most losses in crypto are not necessary. They are not the cost of participation. They are the cost of misunderstanding the nature of the game. Crypto is not a place where you go to win. It is a place where you go to survive long enough for probability to work in your favor. Most people do not survive long enough. They burn out emotionally before they burn out financially. And then they leave. Not angry, not dramatic, just quiet. The market does not defeat most people. Their expectations do. The people who survive in crypto do not look impressive. They do not talk much. They do not post screenshots. They do not predict the future. They behave differently. Not because they are better, but because they have learned what the system demands. The first thing they learn is restraint. They do not trade often. They wait. They accept that most of the time, Nothing needs to be done. They understand that activity is not progress. The second thing they learn is humility. They assume they can be wrong. They assume the market can surprise them. They assume that their understanding is always incomplete. So they build margins of safety. They limit position size. They diversify risk. They avoid concentration. They design for failure. The third thing they learn is emotional separation. They do not use money as a measure of self-worth. They do not attach their identity to outcomes. They do not need to be right publicly. They do not need to prove anything. This gives them freedom. Freedom to exit when necessary. Freedom to be wrong. Freedom to pause. The fourth thing they learn is patience. They accept that compounding is slow. They accept that nothing meaningful happens every day. They accept boredom. And boredom is a competitive advantage because boredom protects against impulse. The fifth thing they learn is simplicity. They avoid complex strategies. They avoid over-optimization. They avoid systems that require constant attention. They choose processes that are robust, not clever. They value reliability more than brilliance. Over time, these behaviors create something powerful. Not wealth, stability. And stability creates optionality. Optionality allows them to choose when to act, when to wait, and when to leave. Most people do not lose because they are unlucky. They lose because they cannot tolerate waiting. They cannot tolerate not knowing. They cannot tolerate boredom. So they act. And action is expensive. The people who survive are not rewarded for their courage. They are rewarded for their restraint. They are not rewarded for their conviction. They are rewarded for their flexibility. And that is why they remain when others leave. Survival is not passive. It is selective. Most people ask the wrong question about crypto. They ask whether it will go up, whether it will survive, whether it is the future of money. But those questions miss the point. Crypto is not important because of what it becomes. It is important because of what it reveals. It reveals how people behave when rules are unclear, how people act when authority is absent, how people respond when opportunity appears suddenly. It is a mirror that shows impatience, fear, greed, hope, discipline, and illusion. Crypto does not change human nature. It exposes it. It shows who seeks control and who accepts uncertainty. It shows who reacts and who reflects. It shows who confuses motion with progress, and who understands that stillness can be power. The people who succeed in crypto are not those who master the market. They are those who master themselves. They do not seek certainty. They seek resilience. They do not seek speed. They seek endurance. They do not seek excitement. They seek clarity. And clarity is rare. Because clarity requires slowing down. In a system built on acceleration, crypto will continue to evolve. Prices will rise and fall. Technologies will improve and fail. Regulations will appear and disappear. But human behavior will remain. And that is where the real game is played. Not on charts, not on platforms, not in predictions, but in decisions. Made quietly, repeated consistently, over long periods of time. That is how people actually make money in crypto. Not by being right once, but by being wrong without being destroyed. Not by predicting the future, but by surviving it. The market does not reward intelligence. It rewards behavior.